Good day, ladies and gentlemen, and welcome to the National Directors Institute web conference. At this time, all participants are in listen-only mode. Should anyone require assistance at any time during the conference, please depress star then 0 on your touch-tone telephone. As a reminder, this conference call is being recorded. I'd now like to turn the call over to your host for today's conference, Ms. Jessica Lockman. Ms. Lockman, you may begin.
Thank you very much. Welcome, everyone, to today's conference. I would like to welcome you to the 5th session of our 2010-2011 National Directors Institute web conference series. This is our 10th annual NDI, and we're very excited about the programs that we have offered for you this year. As in NDIs in years past, we are looking forward to sharing the insights and experiences on corporate governance issues that we think matter most to you. The goals and objectives of our NDI have always been to provide practical insights and useful takeaways to directors, executives, and boardroom advisors. If you missed our prior 4 NDI webinars earlier this year, PowerPoint presentations and audio for those sessions are available on our dedicated NDI website, which is foley.com/NDI. Future NDI webinar sessions can be found on our NDI website. And we held our in-person 2011 NDI in Chicago on January 12th, and program materials for that are posted to our NDI website as well. Our next in-person NDI will be held November 17th, 2011, and we expect the details will follow soon. I'd also like to take this opportunity to thank all of our NDI co-sponsors, many of whom have been supportive to us for years. Aon Corporation, Deloitte & Touche, D.F. King, Eversheds, FD International, UBS Investment Bank, and Vintage Filings, LLC, as well as our in-kind sponsors, Boardroom Bound, Corporate Secretary, and NASDAQ OMX. Today, our program is entitled Investment Committee Responsibilities. Before beginning our discussion, a few housekeeping items that I'll run through quickly. Our conference today will last approximately 1 hour. During this time, you may submit questions via the Q&A tab, which is located on your menu bar at the top of your screen. We will try to answer questions at the end of the program, but if we run out of time, then we will follow up with you individually after the conference. We encourage you to maximize today's PowerPoint to full screen by hitting F5 on your keyboard or from the toolbar menu, selecting View and clicking Full Screen. If you would like to print or save a copy of today's PowerPoint presentation, you can do so by selecting the printer icon at the bottom right-hand corner of your screen. Foley will apply for CLE credit for you after the conference. If you did not supply your CLE information when you registered, please email that information to Elizabeth Harris at eharris, H-A-R-R-I-S, @foley.com. Note that you must log on to both the audio and the video portion to obtain CLE credit for today's seminar. And now the housekeeping is over. I have the pleasure of introducing my partner here at Foley, Mark Waxman, who will introduce today's panelists and lead us through a discussion of investment committee trends and responsibilities. Mark?
Thank you very much, and welcome everybody to our discussion today with respect to investment committee responsibilities. With the stress in the financial markets and the stress of the need to deliver increasing returns from funds that companies, in particular nonprofits, have, there has been an increase in interest, attention, and responsibility as a result for investment committees, which gave rise to today's topic. On our panel today, we have a distinguished series of panelists. Let me introduce them briefly to you. Mike Claiborne, president of the CREATE Foundation. Northeast Mississippi's Community Foundation has been working for the last 35 years in order to invest for a group of nonprofit and community organizations in order to be investment stewards of their funds in order to deliver stability and stewardship to those entities. The CREATE Foundation was the first foundation to be certified by the Center for Fiduciary Excellence, and Mike will be sharing some thoughts with us today about his experience. Second, I'd like to introduce Jane Moncrief, who is the Chief Investment Officer for Care Group, Inc. Care Group, Inc. is a group of hospitals and physician groups in the Boston area. Jane came to the group from managing director position at Cambridge Associates, I'm sure familiar to many of you, and is involved in guiding and directing and working with the Board of Managers, which is the investment committee for this large nonprofit organization. Third, Kate Umili from iCapital. Kate is a founder of iCapital, founded in 1999, an SEC-registered investment advisor, providing investment advisory and fiduciary consulting services on a fee basis to investment committees and organizations involved in pursuing investment returns for their investment committee under their charter. So we have a very distinguished panel with us today, and what we hope to do today is go through a whole series of questions with respect to the role of the investment committee. Its responsibilities is where we're going to start. Many investment committees have a charter which lays out in very general terms sort of what it is that they do and what it is they're responsible for. But I think it's very helpful as we consider, whether to have a charter and what might be in it, starting right at the top of, what really is the responsibility of what is a volunteer committee charged with investing very significant amounts of funds for which there is an increasing need for returns. Let me start, Mike, by asking you, perhaps you'd share some thoughts on that question.
Okay, I think the first thing is that the committee really needs to understand their fiduciary responsibility in the entire process. I think that is a fundamental thing to begin with, and I think that the second thing is to undertake the responsibility of establishing an investment policy statement, because that really, I think, is the foundation for all the other decisions that are going to be made by the committee. So that would be just some opening comments in terms of primary responsibilities.
James, or as an investment officer working with a committee, how would you see this?
Well, I concur with Mike. I think there are a couple things here. It's a volunteer committee, but obviously it's an enormously important one, as you pointed out, with huge fiduciary responsibility. So it requires a lot of commitment, and the committee needs to know that going in, that it's, it's sort of not the same kind of volunteer activity as many others. But the main thing to me is that everyone on the committee needs to be able to articulate both the risks that they are undertaking, the risks that they think are appropriate, and what the strategy is, because the strategy has to be a repeatable one, ideally in perpetuity. So as Mike says, it's really about having articulated a policy and then functioning within the guidelines you've set for yourself.
So, as you look at a policy is one part of an overall charter. The types of charters that you see are, a reference to the committee as a standing committee, its purpose, which would have inherent in it the policy, perhaps, the number of members, the competencies that you might desire, the number of meetings, quorum and voting requirements, perhaps specifically delineating duties and responsibilities as between investment and administrative responsibilities, of which they're both, and then a term which would also be something you might consider. As you look at this and you go online and you look at different charters, Jane, let me come back to you. One of the questions we've posed is, how do you avoid a herd mentality of, let's just do what everyone else is doing?
I think one of the really key things here, and frankly, I think it's something that got lost a little bit prior to 2008, but it's coming back, is that investing involves both sides of the balance sheet. And so, typically investment committees are only thinking about the way to generate return or the way to generate risk-adjusted return. But they really need to understand the other side, which is, how much debt do we have? Is any of it tied to, in covenants, to the investment pool? What percentage of the budget are we supporting? How much non-marketable capital calls do we have, and that's a dollar figure, not a percentage. And then once they understand that they are an individual organization with very specific details, it's much more compelling not to follow the herd, because in fact you don't necessarily look like the herd. So I think that the first piece is again sort of delineating very clearly what is the institution that you're supporting, because that's really why this investment pool exists, to support the mission of this institution.
All right. Now, as you look at different kind of issues with respect to membership of the committee, you have board members, you have thoughts, should we have term limits? What kind of activity should committee members themselves have? And Mike, let me turn back to you as you kind of help see through committees during your tenure. I mean, how do you see the answers to these questions?
Well, our particular approach is that all members of our committee are, in fact, board members of the organization. I know different organizations have different approaches than that, and I certainly don't see anything wrong with that. But again, all our members, investment committee members, are board members of the organization. So they not only have the responsibility from being a member of the investment committee, but they certainly have the overall fiduciary responsibility that it comes with being a board member of the organization. As we look at our committee, we have a fairly diverse group of people. I was just looking at the list, and we've got 5 bank presidents, a CPA, an attorney, 3 manufacturing company presidents. So, I mean, as a community foundation, we draw people from a lot of different sectors, and so as I was just looking at the board members and the responsibilities and knowledge required, I think it is certainly important to have people that are very familiar with the investment process, whether it's on a personal basis, professional, or certainly from other volunteer experience. I know several of our board members are on university foundations and hospital groups as well, and so that is our basic approach. Just one other response is we actually do not have term limits on the committee itself other than the term limits that the board members have themselves.
All right. Well, Kate, let me just ask you, as you've looked at different investment committees, I mean, what have you seen in terms of whether it should be there are all board members, term limits, or just your thoughts about the right complement of talent to have on the committee?
In reviewing various different corporate, nonprofit organizations, volunteer committees, I would just second what Mike is saying. I think having an understanding of the process and an overall understanding of what it means to be a fiduciary to the investment pool that you're managing is important. Policy knowledge. We see a lot of combination committees where board members maybe will appoint the internal committee at a corporation, and then typically the committee members are generally people that are managing that particular fund, whether it's a retirement plan or a working capital fund. We see CFOs, directors of HR, so high-level understanding of investment knowledge, understanding of process and procedure. And when board members are involved, sometimes, most commonly we see, like Mike's organization, that if they are a board member, they're on for the long term. But more and more people are looking for limits, as this job function, does require a time commitment. So the consistency of the committee and, going back to what Jane mentioned, if you have a well-defined investment policy statement, then someone should be able to come onto the committee, review the investment policy statement, review the notes, and have a clear understanding of the goals and objectives of the investment account.
Jane, I'm sorry?
Oh, I'm sorry. I was going to add one thing about
Sure.
Well, and that is, I think we actually have looked at it a little differently in the sense that we do have an investment committee that's an appointed committee of the board of directors, but we make no effort to make sure that people on it are affiliated with the institution in other ways at the board level. And partly it's because we have seen, and I certainly saw this a lot at Cambridge, that it's very easy to have an investment committee get kind of too big and unruly because many people want to contribute, which should be a good thing, except that if you have 15 people in the room, it starts not working well from a process perspective. So we've looked at it as a committee where we're looking for very, very specific commitment of expertise and time, and that's the number one criteria. and on that basis, we have some people who had never been involved with the institution before we called them and said, would you help us invest these funds?
Jane, let me ask you one question that arises as you think about who might be on this, either from the board level or outside, is a lot of the investments out there today are pretty complicated. Should it be expected that every member of the committee fully understands every investment?
To a certain extent, I'd say yes, because I don't, my own personal view is that no one should be invested in things that they can't explain, and that sort of knowledgeable, sophisticated people who understand the sort of financial world can't get up to speed on pretty quickly. So although certainly we love it when people have special expertise in real estate or hedge funds, we also know that if they've just been in the investing universe for a long time, we're not going to put some really esoteric strategy out there because we don't think that that's necessarily, if we can't explain it, we're not sure why we're investing in it.
Mike, let me just come back to you. You've indicated that you have sort of a variety of people on your investment committee. Is there some educational process that all the members of the committee would undergo, or is knowledge of all the different types of potential investments kind of presumed once they get appointed?
No, I don't think you should presume anything. We do have some people that are very experienced and have quite a bit of knowledge on investments, and they don't need a lot of information to understand. But I do think, in our case, that is certainly one of the responsibilities that we look to our investment advisor to provide to us to help our investment committee people clearly understand the investments that we're in. As Jane said, most of them aren't very esoteric, but at the same time, they need to understand the balance. I know we'll get into that in a minute, but they need to understand the balance and the function of the different investments that we have. And so, again, we do rely on our investment advisors to help provide a good, even playing field for all of our investment committee people to understand.
Now, one of the things that you both have mentioned is, you want people who are active and involved in the investment community. That may be people who, through other organizations, for example, being on the investment committee of a university in the area, or even being involved in family foundations or personal investments, may be looking at the same kinds of investments, or specifically the same investments as you are. And so one of the questions that might be asked, Jane, is, can committee members have conflicts, and if so, what do you do with it?
Well, we think of it as sort of there are two kinds of conflicts. There's sort of the ones that we absolutely cannot have and the ones that we have to deal with. So the ones that we absolutely cannot have are investments in funds where someone on the committee has a financial relationship with that fund. So, it's a funny thing here because you may have the opportunity to have the head of a wonderful hedge fund on your committee, and you're just saying by doing that you're not going to invest in that hedge fund no matter how wonderful it is. So we consider that the kind of conflict that you just avoid, period. But the ones that you can't avoid and you just have to manage are ones where, as you say, there's sort of there's a competing interest maybe for a fund where there's limited capacity, and our attitude to that is sort of disclose, avoid if possible, and if not, articulate, disclose, and recuse. And we are sticklers, especially for the recusal part. So when we are talking about something and someone in the room could have an interest, they actually have to get up and leave. It's not enough that they sit there and are quiet. We want them out of the room, and we want to really acknowledge that there's some conflicts that we have to work around. Because, as you say, they're going to be. The minute you get people who are very knowledgeable in financial worlds, they're going to have some moments where their interests sort of collide or combine with yours.
Kate, let me ask you, you've been involved in looking at various investment committees and policies around those committees. What types of policies have you seen around conflicts?
Conflicts are usually addressed in the charter. Committee members are usually acknowledging that they have an understanding that, as Jane mentioned, it should be avoided, that there are just some conflicts that should not be involved in the investment decision-making process. Some of the areas we still see difficult is when the investment committees are governed and, someone's boss is actually the most vocal person in the room, or maybe there's a business interest for the reason why there's an investment in a particular fund or platform or vehicle. So those are the types of things that we generally would recommend be addressed in the charter or bylaws of the investment committee, and then to have all of your investment committee members acknowledge that they are acting, in that fiduciary capacity, in the fiduciary duty that they were appointed to serve. And the recusal is one of the things we commonly see in doing fiduciary assessments and evaluations of prudence.
Thank you. Let's make sure that as we look at the conflict of interest issues, that we do distinguish between conflicts that might arise as a result of individual involvement, individual read broadly between individual, family, where there's a personal involvement in it directly or indirectly, and what we might call conflicts of commitment, where personally there's no interest whatsoever, but what you actually may have are competing organizations looking for the same investment, or if there's a limited amount of opportunity within a same manager, as Jane said, how would those be handled, because they're actually a different type of conflict. Having discussed this matter with Attorney General's offices who look at charities, typically they have not actually thought of the conflict of commitment problem, and typically would focus on the direct, personal, directly or indirectly conflict of interest problem, and both circumstances would need to be addressed. Let's now turn to a different topic, which to what extent can or should, or for what reason should consultants be used? You have situations where you have very knowledgeable members of investment committees who may have their own ideas with respect to specific direct investment. You may need a conversation around a chief investment officer. You may want to interact with a variety of managers sort of all together in terms of how that might work. Let me go back, Mike, and ask you initially, what do you see in terms of, use of consultants?
Well, I think for smaller organizations like ours, it's probably cost prohibitive to have a high-level expertise on staff. And so we've really taken the approach of interviewing investment advisors to provide advice and direction and place the investments for us. And the other thing that I think is important about that is to take the approach of engaging someone who charges an asset-based or some other approach-based fee rather than participating in commissions on placing investments. And so that is the approach that we have taken, and we have leaned pretty heavily on our investment advisors to help provide direction to our committee.
Jane, you're a chief investment officer. What do you think the criteria are as to when you're either big enough, complex enough, or other criteria that might be used to say, we really ought to get a chief investment officer in-house?
Well, I think it's a question really of cost. Under about $1 billion in assets, it's just really tough to maintain an investment office. And, one of the unfair things in the investment landscape is that investment advice and an investment office cost the same whether you have $10 million in assets or $10 billion in assets. There's sort of a critical mass you have to have in place. And so smaller institutions really need to be able to access that advice at a price that works for them, which really means they're in the consulting world or they're in the outsourced world. But, you know, my own view, and obviously it's got sort of a certain baked-in bias since I've been both a consultant and a CIO, is that investing becomes a full-time job, and that a volunteer investment committee certainly can bring the expertise, but they can't necessarily bring the time to do all of the pieces and to look at all of the opportunities that you need to think about to create the best portfolio and get the best risk-adjusted return. So, you know, it's sort of it's not something that people like spending money on because nonprofits, you know, feel sensitive that they could use that money for programming. But I think it's a necessity for really everybody to have either a consultant or a full-time staff, or if they're lucky, a leader of the investment committee who's willing to give very, very, very significant time to the process.
And Kate, you know, again, looking at various committees across the spectrum, you know, are there some practices that you might say, you know, these are best practices that one might follow in a process of selecting consultants?
Yes, absolutely. And, you know, just to add on to Jane's statement, when it's internally appropriate, I mean, doing these types of assessments and evaluating the fees, you know, both direct and indirect, that some consultants, you know, are generating all of the trading costs. Sometimes at a certain level, if you really truly understand the cost, it's going to be beneficial to have someone in-house that can have that time commitment, you know, especially if the investment fund is dealing with working capital, the long-term commitments of the organization, you know, funding different areas of the organization. I think internal expertise so that the policy and the process and the investment knowledge has dedicated full-time professional ability. I am a volunteer member of an endowment fund for a nonprofit organization, and, you know, the staff that we work with is really preparing for this probably a day before the meeting. We're the investment experts, and for the amount of money that the consultants are retaining and then the investment managers, you know, they're only at just about $500 million, but they're starting to make that conversation of whether or not bringing someone in-house with all of their other investment programs might be prudent. And if you're using a consultant, you know, as Mike mentioned, you know, how are you paying that consultant? What role are they going to be taking? Are they consulting you on investments or actually, you know, making discretionary investment decisions for you? You know, what conflicts of interest might they have? You know, do you know exactly any indirect compensation that they may be receiving from placing business with various money managers and or platforms? And, you know, how do you evaluate them in a due diligence process? And I think asking the right kinds of questions about, you know, who they are, how they're going to be compensated, conflicts of interest, their expertise in your area of management. You know, if they specifically work with nonprofit organizations and they have, you know, a wealth of experience there, you know, if they're an individual wealth manager and now all of a sudden they're running, you know, the pension plan that's $500 million. So, you know, evaluating and asking the right questions versus just size and things like that, you know, size, registration, is really important to the overall goal of the investment policy statement.
You know, Mike, I think you indicated that you handle it primarily through consultants. Is there a process that you have typically used to interview consultants and specific questions that you have found more valuable to ask than others, perhaps?
Well, in the past, we have had the same investment advisors for several years, but when we made the selection, we sent out a request for proposals kind of broadly to the area, received those proposals, and then just evaluated them in regard to certainly their philosophy, their performance, and you know, how that we thought they matched up with our interest. And so that you know, that worked well for us. We brought in, I think, at the very end, 3 companies to make presentations to our investment committee, and then just develop consensus there of who really matched up with our committee, and a lot of it has to do with style and approach, and in addition to return. So that basically is how we went through that process.
And Jane, let me ask you, you've dealt with a fair number of managers over time. I mean, is there a process that you would recommend in evaluating a manager?
Absolutely, and I'd make one quick comment about consultants, and then because I think it extends into that manager question. I totally agree with Katie that you have to have a consultant who's independent. You can't have someone who's receiving revenue from making recommendations or gathering assets for people. That's just sort of a non-starter. But the other thing is that I think the most people think of consultants or outside advisors as helping with that implementation piece, but in fact the really good ones help with the process piece. They're the ones who can help steer the committee, help them figure out how to articulate the strategy and make sure that they stick with the strategy. And in terms of managers, to me that's crucial because many investment committees know many managers, and so there's a desire or a tendency to feel like someone who's a good investor and maybe it should be in the portfolio. The conversation around when you're interviewing a manager is to really understand what that process is, so you understand what is the function of that manager in your portfolio. When's he going to perform well? When's he not going to perform well? What is the risks that you're taking on? What's the return expectation that you could have relative to those risks? And is it a good match with whatever else you have in the portfolio? So is it additive as opposed to duplicative? Those conversations are funny because managers often want to talk to you about returns. I find what I want to talk to them about is process and repeatability of process. The returns are numbers on paper. I'm going to see those numbers one way or the other. What I want to understand is how they got there and whether they can do it again.
Jane, it's a great comment, and I just would like to add to that, that the consultants will go through the process, and, certain consultants will not have any overall authority in selecting the investment. So the manager interviews and the fundamental evaluation can be critical. The numbers are readily available, but how are those numbers with the fundamental process going to help on a go-forward basis? And Jane, like you interviewing managers and talking to them, all they want to talk about is performance. So it is a crucial element.
So that leads right into our next slide, which is we've talked for a minute about the front end. What's the interview process? How do you go about selecting them? The next question is having focused on consultants and managers, advisors, what is it you actually tell them you want them to do? And then how do you and how often do you determine whether they actually did it? And Mike, let me come back to you initially on this one and say, you've had some fairly constant and stable set of advisors and so forth. And how do you evaluate them?
Well, I think it goes back to, an earlier comment that Jane made about what is your objective. And so I think you have to establish what is your fund objective, what is a reasonable expectation for the performance of your fund. And so that's the first thing that we did in discussion with our investment advisor and our committee is what's appropriate for us and what will achieve the long-term results that we're looking for our foundation. And I think another key part of that too is depending on perhaps where you live and the nature of the people that live in your area. That is something that is important to us because, for example, I know there are foundations that take a much more aggressive approach than we do, and perhaps at the end of the day arrive at a place maybe slightly above where we are. But at the same time, the ride getting there is very different than the ride that we take, and so I think that is for us and the people that we serve and represent in terms of the funds that we have, that's a part of the equation as well. So basically, I think you start out with what is your fund objective, and is that reasonable, and does that match up with the people that you're serving?
Mike, let me ask you, you've mentioned, others have mentioned, we're looking at the, quote, long-term, end quote. Do you look at long-term as 2 years, 3 years, 12 years? I mean, how do you evaluate that?
Well, I'm just looking at one of our last reports, and we look at our activity annualized since the inception of the fund. We look at the last 3 years, the last 1 year, year to date, and the current quarter. And so, I mean, we're looking across the board in terms of the performance over a longer period of time, but certainly what's happened currently is not unimportant as well. And so we're viewing the performance of our fund and the performance of our investment advisors relative to, again, first our fund objective, and then we use a custom blended index in regard that matches up to the target levels of investment in the different categories. Also, we're looking at some other indexes as well. Our basic approach is in the 65% equity, so we're looking at a 65% S&P 500, 35% bond. Also, we look at the S&P 500 and another bond index just to get a good viewpoint of what is happening in the investment universe, but really come back more and focus on our fund objective and our blended index. We think that is really where the performance of our fund and our investment advisors need to be measured.
Jane, you mentioned that you make selections based on what's the fit in terms of the overall goals that you've established and the capital allocation across categories. But once you've made the selection, so let me ask you, what is the actual charge to one of your managers to do, and what kind of performance are you actually looking for, and what would give rise to either giving them more money or less?
Well, I think, one of the things I try and stress is that we should understand what the criteria are for firing a manager the day we hire them, so that if their performance is disappointing, but that disappointment matches what we think they do, that's not necessarily a reason for firing them. We think a lot about the fact that you can't beat a market and look like a market at the same time. So the minute you say, I want to invest in U.S. equity, but I want to do better than the S&P, you know that you're not going to track the S&P. And, the way we think about it is valuation-based as well as process-based. So on a valuation basis, we give people more managers more money when we think their opportunity set is good because we think their stocks are cheap. On a process basis, we're looking at returns. We like to look at returns on a rolling basis, and the longer, the more different from the index the manager is, the longer we like that rolling period to be, because they're likely to have big periods of outperformance and then big periods of boring performance. So you have to look over really long periods to sort of even out the peaks and the valleys. We fire managers when we feel like we're not sure anymore about the integrity of the process. So it can be they're not doing what they used to do, or their attribution when they're doing what they do is getting worse than it used to be. So they used to be able to make money in a hedge fund on the long side and the short side, but now they're not making any money on the short side. Or they lose key people. And it's really rare that we fire them simply because they had a bad year. We like to think that we've done such a good job picking people that we trust them, and they're allowed to have a bad year if we think the next one might be a good one, and if we understand what happened in that time period.
Okay. How should the results of the committee actually be monitored in terms of how well the committee itself is doing? And maybe, Kate, let me start with you and say, can you give us kind of what you've seen as best practices in terms of what committees actually do?
Yes. And one of the things I'd just like to add on to the final statement that Jane was mentioning about performance, if some of you do not have a resident expert like Jane on staff and you're evaluating your consultants and your managers, knowing the performance calculation methodology that they're utilizing to report their results to you and understanding that, you know, is it a time-weighted rate of return? It's neutralizing your cash flows and you're getting, you know, the true investment manager performance. And then establishing the guidelines because, you know, as Jane mentioned, performance, you know, should be looked at on a quarterly basis to pick up trends. But managers, if you understand their investment process and their philosophy, you should be able to follow those trends over a longer period of time. And then the quality of information of the reports, can your investment committee members actually read that information? Is it too complicated? Do they really truly understand the report so that they can do their job from a, you know, evaluation standpoint? And then what we're seeing, you know, as we go through and evaluate investment committees and look at their process is we're seeing investment committees trim down in size. You know, we mentioned that earlier in the discussion, and we're seeing people that are committed to the process. You know, the larger the fund, typically we're actually not seeing the numbers increase. Where we're seeing the numbers stay at high levels is probably in the mid-corporate world, you know, the $100 to $500 million fund that they're managing, where we're asking for representation from various different parts of the organization, and we're seeing that trend go away. So, you know, somewhere in the 3 to 5 member range is typically what we see, an odd number, so that voting is a little bit more consistent. And then the education and then evaluation, we're seeing investment committee members really pay attention to, you know, setting up routine independent verification. You know, are they following the investment policy statement? How have they, you know, produced positive results, you know, for the beneficiaries of that particular fund? Are they staying educated on trends, you know, both from an asset class perspective and from a policy perspective? So, you know, we're seeing it, the smaller, the better, and I think the more efficient. And I think what we're seeing a lot more of in the active world of investment committees is peers, where you don't have one particular person taking control of the investment committee, and it's a peer group of either executives or board members.
I have to ask this one question, which you know, a lot of people are interested in. And Jane, let me ask you this: you know, how do you benchmark alternative investments?
You know, I think there are two ways to think about it. One is one's the sort of marginally easier one, which is if you're looking at a group of hedge funds, you know, there are 5 or 6 really good fund of funds out there. You can benchmark yourself against that. There are a couple of indices, but they're not great. And then lockup, non-marketable funds you can benchmark against the vintage year, so essentially against the opportunity set, the investable opportunity set. And Cambridge Associates has published a lot of those indices or made them available so people can say, well, you know, for 2003, how did people generally do in real estate? Okay, how did I do? But, you know, I think the other, you know, the harder one is to simply say, what was my goal for investing in this asset class? So in hedge funds, you know, it's really about reducing volatility as well as returns. So you have to say, well, did I hit on both counts? Did I capture as much of the market as I wanted, and did I reduce the bumpiness of my ride? And in the non-marketable area, I think you say, you know, how much do I want to get paid for locking up capital for 10 years, and then see whether you made that money relative to having the money in the public markets.
Let me move on to, you know, liability type issues. We've put out some of the questions that one might think about. In the interest of time, we might go fairly quickly through these next. We leave a couple minutes for questions at the end. But Kate, maybe you could quickly address some of the processes and elements that you might add on to indemnity insurance and so forth.
Absolutely. So, as committee members, especially directors, your directors and officers coverage, you make sure it has a fiduciary rider for that job function. And if you're working with investment advisors and consultants, you should be asking the type of errors and omissions and fiduciary bond coverage they have, whether they're a state registered or federally registered firm. That's changing under the financial reform. So registered investment advisors, with the exclusion of pension consultants, need to be at $100 million or more of assets under management, and they also need to produce a new disclosure document that's in clear and concise, easy-to-read language that addresses most of these conflicts that we've talked about, and committees should be asking for that document. And then making sure that you understand the exclusions on your insurance policies, and that you don't have a direct conflict of an exclusion on an insurance coverage, because you want to protect your personal assets in the event of a claim for any volunteer committee member.
Okay. We've mentioned in my introduction that there's something called certification and certification of investment committees. And Kate, could you tell us what does that mean and what could it be?
Absolutely. The Center for Fiduciary Studies, very commonly known as CFEX, the certification body, has developed a certification process that actually evaluates investment stewards, so those of you that are members of volunteer investment committees, registered investment advisors, record keepers, and they certify the best practices that have been developed by FI 360. So as an investment steward, there's a global best practice that's been substantiated by case law and regulatory opinion, and investment steward certification is having independent verification that the process that you're adhering to as an organization, you are actually having an independent analyst come in and evaluate your adherence to the global best practices. And registered investment advisors have a different certification than investment stewards. And this process is really about uncovering, it helps establish a written, evidence of prudent investment process. It can help you uncover procedural risks and should help with long-term performance because the process is defined and established. And then it's a tool for evaluation. I was actually the CFEX independent analyst. That's how I met Mike. And I was actually the independent analyst to certify the CREATE Foundation. And they were the first public foundation to actually go through this process. And I would just ask Mike to echo what he learned and maybe what it's done from a helpful standpoint for gaining the trust of investors, because I think that's the ultimate goal. As a firm, we are CFEX certified, and I know investors enjoy the concept that we're willing to go through that independent audit on an annual basis for what we're doing. So, Mike, do you just want to add to that?
Yeah, I would. I mean, as we went through the process, we probably were doing 80-85% or more of the steps in the certification process, but it certainly uncovered some things that needed strengthening in our process. I think the key word that Katie mentioned several times is independent evaluation. We can tell people that we adhere to all the best standards of practice, but to actually have someone independently come in and verify that we, in fact, are doing that, I think is very helpful. When things are going great and returns are going well, nobody asks many questions. We have about 150 different endowment funds invested, and particularly in times when things aren't going so great, people want to know, are you doing the right things Are you being the best fiduciaries of the funds that we've entrusted to your organization? And certainly there's no guarantee on return, but at the same time, I think it gives our committee a degree of comfort to know that, in fact, we are using the best practices and highest standards, so I think it's been a very good thing for us, and we've been very pleased with the process.
Let me turn sort of as a concluding type question for a comment to, what's the biggest challenge in operating the investment committee? And Jane, why don't you start, what do you see as the biggest challenge?
I think the biggest issue is it's probably time, but the biggest practical issue is that the process really matters, and it really has to be repeatable. And in my experience at Cambridge Associates, when I came in to see a new client, the bulk of the initial work was just, what do we know about the portfolio? What do we think we know, and what do we actually know? And what are the numbers telling us? And have our investments actually reflected what we think? And, surprisingly, when you go through that exercise, I think a lot of times you find out the numbers might be telling you something different, or you might be taking risks that you hadn't really thought about. Again, 2008, I think, is a really interesting and obviously sad example for that, because many institutions felt like bonds were bad. And they had sort of forgotten about the tension of needing to spend right now, even though you're a fund in perpetuity. So it's about, the key thing there is really kind of getting into the weeds and making sure that even though it's a volunteer committee, everybody has really internalized what this strategy is and what this process is and what are the risks we can take and still sleep at night. And that takes a whole lot of time.
Mike, what's your thought? Biggest challenge in operating an investment committee?
Well, I think investing in new areas is certainly one. I mean, as I stated earlier, we have a very conservative group, and for the first time this year we invested in a hedge fund of funds. And it wasn't a substantial amount of money, but there was, as they say, a lot of weeping and gnashing of teeth about the appropriateness of that. And again, you have to understand this comes from a very conservative group. So I think, but that's good, in that it is a strong indication that they care deeply about their fiduciary responsibilities and want to make sure that they're, to the best of their ability, they're doing the right and best thing for our funds. And so I think that probably is one area. And then I think also communicating with the constituents. Again, it's not hard to communicate when things are going well, but when you have a 2008, then that communication is a little more difficult, and certainly you need to be able to address what your process is, and say that you've got confidence that over the long term that our process is going to take us and the funds where they need to be.
Okay, and Kate, what have you seen as the toughest thing for investment committee?
I'll focus on a different area, maybe some smaller organizations, that either can't afford consultants or, internalizing a chief investment officer. I think it's the necessary resources to understand how to define the process. The biggest challenge I see for, very established organizations, these volunteer investment committees have been appointed. There's a process in place. No one's quite sure of how that process was developed. And, Jane, as a consultant and being a fiduciary consultant and investment advisor, every time we're engaged by a client to go in and either take over the investment management or evaluate the process, we're always finding something. And generally what we're hearing from the committee members is they don't have the resources, they can't convince people to spend more money in this area, Most of the investment committee members really understand their fiduciary responsibilities. That's what we clearly see. But getting them the necessary education and resources so that they can ask the right questions and know when something, maybe not in the best interest of the beneficiaries of that fund, I think is extremely hard. And then the communication is always a challenge, and the time.
All right, I want to thank our panelists for the insight of their comments, and also we've left a few minutes for questions. Jesse, let me turn it back over to you.
Thank you, Mark, Kate, Jane, and Michael. These were excellent insights and practical takeaways, and I'm sure our audience is appreciative. Because we did not get to all the questions, we will follow up with you individually if you have posted any, and panelists will get back to you after the conference. We certainly hope you enjoyed today's presentation. We ask that you take 27 or so seconds to participate in our brief online survey at the conclusion of this call. These surveys are helpful to us in ensuring that our NDI programs are providing you with practical advice and recommendations, and will help us develop ideas for future NDI topics. Again, thanks for attending our NDI, and we'll talk to you next on May 18th as we address sustainability in the boardroom.
Ladies and gentlemen, this does conclude today's presentation. Thank you for joining the conference. You may now disconnect, and have a wonderful day.